a legendary brand, and a stock now trading nearly 50% below its peak from last year. Wall Street says the rebound is coming, but the numbers Nike is putting up right now tell a more complicated story. At around $42 a share, almost everyone is asking the same thing. Is this finally the bargain of the year? The bull case is genuinely strong, so let's give it a fair hearing first, and then put it to the test. 36 Wall Street analysts cover this stock, and while they officially rate it a hold, their average price target still sits around $60. That's roughly 44% above where it trades today. And the case behind that target is real. Nike has a new chief executive, Elliott Hill, leading a turnaround he calls Win Now, clearing old inventory, refocusing on sport, and rebuilding the brand. The company has also raised its dividend for 24 years straight, through recessions and slumps alike. And it's not all red on the income statement either. North America, Nike's biggest market, actually grew last quarter, with footwear up 6%. So there is a genuine foundation here to build on. It's a clean, compelling story. Now let's hold it up against the latest numbers. On March 31st, Nike reported its third quarter. So let's read what actually happened, not the narrative around it. Revenue came in at $11.3 billion, which is flat year over year, and down 3% once you strip out the currency boost. Earnings per share landed at 35 cents, down from 54 cents a year ago, a drop of 35%. Now, I'll level with you here because this is where shallow analysis trips up. Part of that 35% drop is really a tax story. Last year, Nike's tax rate was an unusually low 6%, and this year it reset to a normal 20%. So, on an operating basis before tax, profit actually fell about 23%. That's 23, not 35, but either way, the direction is clearly down. And the pressure shows up almost everywhere else too. Gross margin shrank 130 basis points to 40.2%, squeezed by new tariffs. Greater China fell again, down 10% stripping out currency, and it has been sliding for more than a year. Converse, Nike's other brand, collapsed 35% and tipped into an operating loss. There's one more detail a careful investor would notice. Even as profit fell, Nike kept raising its dividend and buying back stock. In other words, rewarding shareholders out of a shrinking pool of earnings. This isn't a company quietly compounding. It's a business that, at least for now, is contracting. So how does my model turn all of this into a number? It starts with two lenses. The growth lens values a company on how fast it's expanding, while the value lens judges what it earns today against its peers. But before either lens runs, the model scores the underlying business across three areas of health: cash flow, growth, and profitability, each graded from 0 to 10 against the sector. Let me show you how that works, because this is where the verdict really comes from. Let's start with cash flow. Nike's balance sheet itself is sturdy. Interest coverage and liquidity both score well, but the cash flow margins are thin, with operating cash flow margin at just 3.6%, sitting in the bottom third of the sector. That nets out to a middling 5 out of 10. Next is growth, and this is where the story really falls apart. Revenue, earnings, gross profit, operating income, cash flow, every single growth metric is negative, and diluted earnings per share are down 56% over 3 years. Most of these rank in the bottom fifth of the entire sector, so growth scores just 1.7 out of 10. Profitability is the one relative bright spot. One key metric here is the EBITDA margin, essentially how much of every sales dollar becomes operating profit. Nike sits at 8.3%, right in the middle of its sector, so the model scores it just under 5. Return on invested capital at 10%, lands in the top quartile and scores nearly 8. Together, profitability is Nike's strongest area, at about 6 out of 10. So, stack the three together: middling cash flow, decent profitability, and almost no growth. And it's that growth score that's decisive because you simply can't value a company on growth it isn't delivering. So, the growth lens sits out, and the value lens takes over. And here's what the value lens sees. At around $42, investors are paying about 24 times earnings and 17 times EV to EBITDA. The rest of the sector, by comparison, trades at roughly 9 times earnings and 7 times EV to EBITDA. Think about that for a moment. That means investors are paying more than double the typical sector multiple for a company whose profits are currently falling. And remember that quality scorecard? Nike's overall score came in just below the sector average, so the model gives it no quality premium to justify that gap. Even if I tilt the model hard toward Nike's own history, its glory day multiples, and give it every possible benefit of the doubt, fair value still only reaches about $34, which is 19% below today's price. Put it all together, and the model's fair value lands at roughly $29, about a third below the current price. The verdict on today's fundamentals is overvalued. So if my model says overvalued, why do Wall Street and Yahoo Finance see a bargain? It's not that anyone's wrong, we're just measuring different things. Their models price in the recovery, the margin rebound, the China comeback, the turnaround working. Mine values what Nike earns today, not what it might earn years from now. And to be fair, Nike has come back before, after 2017 and after the pandemic. So it really comes down to one question. Do you believe the turnaround is coming and coming soon? If it is, the analysts are right, and today's price looks cheap. If it stalls, the market's been paying for a recovery that hasn't arrived. So here's where I land. For now, Nike looks overvalued on today's fundamentals with a recovery story that still has to prove itself. And that story gets its next big test on June 30th, when Nike reports earnings. Right after those numbers land, I'll run them through the same model and post an updated Nike verdict. So subscribe and hit the bell if you want to see whether the turnaround is finally showing up. Until then, that's the valuation verdict.